Picture this. You finally saved up $1,000. Maybe it took weeks of grinding at your part-time job. Maybe it was your New Year's resolution to actually stop spending $8 a day on coffee. Or maybe you just want to make your money work harder than sitting in a dusty savings account. Do you buy a few shares of Tesla, Apple, or Microsoft, hoping they skyrocket? Or do you put your money into something called an ETF, which is basically like buying a basket of different stocks all at once? It feels like standing at a fork in the road. On one side, stocks, risky, exciting, a shot at big gains. On the other side, ETFs, safer, slower, but steady. The question that trips up almost every beginner is this: which one should you actually choose in 2025? Here's the truth. Both stocks and ETFs can make you money. Both can lose you money. But the way they work and the kind of investor they're built for is very different. If you're just starting out, understanding that difference could mean the gap between making smart, stress-free returns or losing your shirt trying to chase the next meme stock. Stocks. So, imagine this. You're walking down the street and pass by an Apple store. Bright lights, lines of people waiting to buy the new iPhone, the smell of freshly unboxed gadgets. It feels like money is being printed right in front of you. Now, imagine you could own a little slice of that. Not the store itself, not the phone, but the company. That's what a stock is, a tiny ownership share in a business. When you buy a stock, you're basically saying, I believe in this company. I believe it'll grow, and when it does, I want to ride the wave. If Apple's profits go up, if people keep lining up for those shiny new phones, your slice of the company, your stock, usually becomes more valuable. That's how you make money. Either the stock price rises and you sell it for more than you bought it, or the company rewards you with dividends, small payouts just for holding on. But here's the catch. Stocks are like roller coasters. One day, Tesla is up 10%. The next, it's down 12% because Elon tweeted something about robots or Mars. Stocks move fast, and they don't can about your feelings. For beginners, this can feel like gambling. You wake up, check your portfolio, and suddenly that $1,000 feels like it's either doubled overnight or been chopped in half. Why? Because when you buy a stock, you're betting on one company. And one company can mess up. Bad management, bad earnings, bad luck. Think about Enron in the 2000s, or more recently, companies like Bed Bath & Beyond that went from household names to bankrupt cautionary tales. But here's the upside. Stocks are where fortunes are made. Amazon, Google, Netflix. If you'd put just $1,000 into any of those in the early 2000s, you could be sitting on tens of thousands today. The appeal is obvious. High risk, high reward. So for beginners, stocks are thrilling. They're like picking your favorite sports team and hoping they win the championship. If they do, you're golden. If not, you're crying in your portfolio. That's the stock market in a nutshell. Ownership slices of companies that can make you rich or make you broke. ETFs. Okay, so now picture this. You walk into a grocery store with $100. You could spend it all on one giant cake. Looks delicious, might taste amazing, but if it's bad, you're stuck with it. Or you could use that same $100 to buy a little bit of everything: bread, fruit, rice, eggs. Even if one item isn't great, the rest keeps you fed. That's basically what an ETF is. ETF stands for Exchange Traded Fund. Fancy words, but here's the simple version. It's a basket of investments you can buy with one click. Instead of putting all your money into just Tesla or Apple, you're buying tiny slices of hundreds of different companies all at once. So if Apple has a bad week, maybe Microsoft has a good one. If Tesla crashes, maybe Coca-Cola holds steady. ETFs spread out your risk, so you're not relying on one company to carry your entire financial future. But the cool part, ETFs trade just like stocks. You can buy and sell them on the same apps, in the same way, at the same speed. But instead of owning just one company, you own a collection. Take SPY, for example, the most famous ETF in the US. It tracks the S&P 500, which is basically the top 500 companies in America. By buying one share of SPY, you're instantly invested in giants like Apple, Amazon, Google, and 497 others, without having to buy each one individually. For beginners, this is gold. Why? Because most people don't have the time or the stomach to research every company, follow earnings reports, or make decisions on when to buy or sell. ETFs do that heavy lifting for you. They give you instant diversification, meaning your $1,000 isn't riding on a single stock, but on the entire market. But ETFs aren't perfect. They move slower. You're not going to wake up tomorrow and find out your ETF doubled overnight. The flip side is you're also less likely to wake up and see your entire investment cut in half. It's steady, predictable, and boring in the best way possible. Think of stocks like betting on one horse in a race. Think of ETFs like betting on the whole racetrack. One horse might stumble, but the group keeps moving forward. For beginners in 2025, ETFs are often the training wheels of investing. They protect you from catastrophic mistakes while still giving you a front-row seat to market growth.
ETFs versus stocks. So, here's the showdown. It's 2025. On one side, you've got stocks, flashy, risky, unpredictable, but full of potential. On the other, you've got ETFs. Steady, balanced, a little boring, but safe enough to let you sleep at night. Let's walk through what this actually looks like. Imagine you take $1,000 and put it all into Tesla stock. If Tesla has a great quarter, releases a new car, or nails some AI breakthrough, your $1,000 could become $1,500 in a few months. That's exciting. But flip the coin. If Tesla struggles, your $1,000 could shrink to $700 just as fast. Stocks are basically a magnifying glass. They amplify the good and the bad. Now, take that same $1,000 and put it into an ETF like SPY. Instead of betting on Tesla alone, you've spread your money across 500 companies. Tesla could tank, but Apple, Microsoft, or Coca-Cola might be thriving. Your $1,000 might become $1,050, then $1,100, growing slowly but steadily. Less drama, more predictability. Here's the big difference. Stocks can make you rich faster, but they can also bankrupt you faster. ETFs grow your wealth slower, but they almost never leave you completely wiped out. It's like the difference between sprinting and marathon running. Stocks are sprints, short bursts of energy, high stakes, sometimes exhilarating, sometimes painful. ETFs are marathons, slow, disciplined, and designed to get you across the finish line without collapsing. For beginners, this choice matters, because the truth is, most new investors aren't ready for the emotional roller coaster that stocks bring. Seeing your hard-earned money swing up and down by 20% in a week can make even the calmest person panic sell at the worst possible time. ETFs smooth that out. They're like training wheels. They let you experience the market without the whiplash of single stock volatility. But here's where it gets tricky. In 2025, the lines are starting to blur. You've got ETFs focused on tech companies, AI companies, green energy, even crypto. Some ETFs are almost as risky as individual stocks because they're concentrated in one hot sector. Meanwhile, some blue-chip stocks are so big and stable, think Apple or Microsoft, that they behave like mini ETFs all on their own. So, which one's better? That depends on you. Do you want excitement, big wins, and the possibility of big losses? Stocks are your game. Do you want safety, consistency, and a slow build towards wealth? ETFs are the safer bet. But for beginners, the safest answer is this. Start with ETFs, then add a little spice with stocks once you're comfortable. Here's the thing. The choice between ETFs and stocks isn't happening in a vacuum. It's 2025, and the game has changed. Interest rates are still higher than they were a few years ago. Inflation, it hasn't completely cooled down. Housing is expensive, groceries feel like luxury items, and people are desperately looking for ways to make their money grow faster than the cost of living. Then there's technology. AI isn't just in the headlines, it's shaping the stock market itself. Algorithms are trading faster than humans ever could. AI-driven ETFs are popping up, ones that automatically rebalance themselves based on machine learning predictions. It's like having a robot hedge fund manager working for you without the six-figure fees. But volatility is also higher. One tweet, one global event, one regulatory change, and stocks swing wildly. Beginners diving straight into individual companies often get caught in the storm. It feels like being in a casino where the rules change every hour. This is why ETFs are especially powerful in 2025. They give beginners stability in a world that feels anything but stable. Want exposure to AI companies? There's an ETF for that. Want clean energy? There's an ETF. Want the whole US market? There's an ETF. You can still ride the trends, but you don't have to bet it all on one company that might flame out overnight. That said, stocks aren't dead. In fact, some of the biggest winners of this decade are likely to be individual companies leading revolutions in AI, biotech, green energy, and space tech. The risk is higher, but so is the potential payoff. Owning stocks is still how you go from comfortable to life-changing wealth. But here's the catch. In 2025, information spreads faster than ever before. That hot stock tip your coworker just gave you? 10 million people on Reddit already heard it yesterday. The edge is smaller and the noise is louder. For beginners, this makes ETFs even a stronger starting point because they cut through the noise and let you benefit from the broader trend without chasing every rumor. So, when you ask, ETFs or stocks in 2025, the context matters. The economy is shakier, the tech is smarter, and beginners need protection more than ever from the chaos of the market. If you're just starting out, ETFs are the smarter play. They're safer, more stable, and let you grow your money without losing sleep every time the market sneezes. Once you've built that foundation, sprinkle in a few individual stocks, the companies you truly believe in, for some extra upside. Think of it like building a house. ETFs are the concrete foundation that keeps everything steady. Stocks, they're like the flashy upgrades, the pool, the rooftop garden, the marble countertops. Nice to have, but useless if the house itself isn't standing strong. So start simple, start safe. And remember, in investing, time beats timing. Whether you pick ETFs, stocks, or both, the real secret isn't the choice you make today. It's staying invested long enough to let your money do what it does best, grow.